Good morning, Bitcoiners, and welcome back to your Bitcoin economic calendar, the news and analysis you need to start the week off right in Bitcoin. Today is Monday, May 31st, and happy Memorial Day weekend to our friends down in the US. In today's episode, we're going to start by talking about Mr. Ray Dalio's comment last week saying that he would rather own Bitcoin over bonds. Next, we're going to break down the size of the bond market to understand just how meaningful the implications of that comment could be. And lastly, we're going to talk about inflation speak in the mainstream media. We're going to talk about why that conversation tends to start with food and what may be next in that narrative. So grab your coffees. It's going to be a good one today. Before we get started with today's episode, we wanted to announce our savings rates as of June 1st. So as of June 1st, our Bitcoin savings rates will remain the same at 6.1% APY for your first 2 Bitcoin and at 2.25% APY for any balances above 2 Bitcoin. Our USDC rates will be going to 11% APY. Again, you can earn the best rates in the industry by checking out ledn.io and our savings accounts. Starting as we usually do with Bitcoin, we see that Bitcoin caught a bid last week in the low 30,000s after having dropped from about 65,000 in the 2 weeks prior. And it tried to make a run up to the 40K level. However, it could not get past that 40 level, and it essentially came all the way back down to the mid to low 30s and settled the week at $35,677, up 2.8% for the week. As we can see here, this was a candle that had an attempt at a run up, but essentially was not able to and ended up settling back. We're seeing some more positive action and some more consolidation around this range this morning. Now, in terms of developments, the biggest news in Bitcoin last week, at least in our opinion, was the comment that we highlighted at the beginning saying there was Mr. Ray Dalio, who essentially said in an interview, and I quote, "I'd rather own Bitcoin than a bond." Why this comment is so meaningful is for a few things. So for context, let's start by setting some additional context on who Mr. Ray Dalio is in the minds of financial media. So Mr. Ray Dalio is defined by Wikipedia as one of the greatest innovators in the finance world, having popularized many commonly used practices, end quote. So Mr. Dalio, needless to say, is a very influential name in the finance world, in the investment world in general. Next, to try to understand how important or how relevant this is because of the size of the bond market, let's talk for a second about the size of the bond market. So according to data from August 2020, the size of the bond market was estimated at $128.3 trillion. Of that $128.3 trillion, around 41 trillion is in corporate bonds, and around 87 trillion is in SSA bonds. So these are sovereign, supranational, or agencies bonds. You can largely think of this as just government bonds, just for simplicity's sake. Now, according to the same data, and if we go down here to see how big the US's share is of all of this, the US makes up out of the $87 trillion in government debt, the US makes up 22.4 trillion of that in that same data set. China makes up 19.8% of that same data set. So again, pretty big. The US makes up about 26% of all sovereign debt out there. And about $10.9 trillion of the corporate bond markets belong to US debt. So again, the US makes up about 26 to 27% of all bond debt, whether corporate or sovereign. And to put this into further context, and these numbers, by the way, are over 1 year old, so they are likely even higher. But for context, Bitcoin's market cap is currently sitting at 672 billion. So many, many times smaller than the bond market. So why is this important? Let's go back to the chart for a second. But mainly, this is important for many reasons, but let's try to break it down. As the Fed starts to consider tapering, which means slowing down the speed at which it is buying its own government bonds, which is the first step in raising rates. The second step of that is actually raising the overnight rate. When that happens, bond investors in the US in particular could be in for a world of pain. The reason for that is the inverse correlation or the inverse relationship between the bond's interest rates and their prices. As interest rates rise, the market value of bonds goes down. While a bond will have a set face value, which is the amount that the issuer pays back the holder at maturity, assuming the issuer does not default, in the secondary market, bonds can trade at prices below their face value. What this means is that when their interest rates rise, it's because the market value of these bonds is decreasing, but the face value and their interest payments are staying the same. To get a sense of how fast the bond market has been growing, take a look at the rate of issuance. Look at how much it has skyrocketed. And this has a lot to do with the fact that interest rates are at record lows, which makes it all that more attractive or appealing to raise debt. So with bond markets set to potentially decline and investors like Ray Dalio stating that they would rather own Bitcoin over bonds, it's interesting to consider some hypothetical scenarios. Again, given the sheer difference in size between these two markets, the tiniest change between the two could have big implications. So to illustrate this, if 1% of the capital deployed in the US corporate bond market alone, US corporate bonds, was relocated to Bitcoin, this would represent around 50% increase in Bitcoin's market cap. For further context, the US corporate bond market alone is about as large as the total market capitalization of gold globally. So just to get a sense of how big these markets are and how important or relevant it is for somebody like Ray Dalio to be saying that he would rather own Bitcoin over bonds. To bring it back to the Bitcoin market structure, let's take a look at what the futures are showing us. And what we see here from these futures, and it's just going to try to pop up one more curve. What we see from these futures is that they actually seem to be pricing quite a flat summer, with prices in Bitcoin not picking up, or at least not showing to be dramatically higher into the fall. So September 27th contract is the one where we start seeing some noticeable upticks. And we still see here that the July and the August contracts are trading quite flat relative to where we are in the spot prices today. So again, just keeping an eye of what market structure continues to show after the dust settles a little bit after that big drop. Moving over to the S&P 500, we see that it closed last week at 4,206 points, up 1.07% for the week. Helping that move was the fact that we've had relatively stable bond yields. Last week, they closed right within range of where they have been for the last, call it 8 weeks. And in addition to that, we had the US dollar having quite a stable week last week, pretty flat, up 3 base points. But again, no change is typically good no change in the dollar and no change in the 10-year yield keeps the attention focused in some of the market fundamentals. And this tends to be positive right now, which with the yield and the dollar taking so much attention week over week, when they don't have the spotlight on them, it allows investors to focus back on some of the other fundamentals in the market. So again, that stability helped the S&P grind a little bit higher last week by 1.07%. And the other thing that helped quite a bit was the budget that was presented by the Biden administration, which there's many headlines around this last week. But again, just to talk about it briefly, Biden last week presented a $6 trillion budget, which again is really, the number came in relatively high, given that $6 trillion is really pre-pandemic spending levels. And what it tries to do to sort of make up for that huge increase in spending is to raise taxes quite dramatically. However, the plan still has a deficit of over $1 trillion in debt to be added to the US annually. So again, this helped markets grind higher, albeit there was not great volume traded in the S&P last week. So something to keep our eyes on. Going back to the budget and to talk about why it raised, or it had so many people talking about it. To put things in perspective, the 2020 budget, which was mid-pandemic budget, was $6.6 trillion. and the 2019 budget was $4.5 trillion. So very clearly, we see here that the administration is proposing to continue this, to keep essentially spending levels at pandemic levels for quite some time. Given this, the only thing holding back the markets is the potential for the Fed to start moving towards tapering and higher interest rates. And that has also many people questioning whether that's actually something that could happen. We'll talk about this more in our What's Ahead section later today. But just to bring it back to the activity, and with so much riding on the Fed, although it is a shorter trading week although it's a shorter trading week in the U.S. capital markets, there will be Fed activity for most of the week starting tomorrow. So tomorrow, Tuesday at 2 p.m., we get Fed Governor Lael Brainard giving a speech about the Fed's economic and monetary policy outlook. Then we get Fed Vice Chair Randall Quarles on Thursday at 3:05 p.m. discussing financial regulation. And lastly, Friday at 7 a.m., we get Jerome Powell, who will be speaking about central banks and climate change. So again, with so much riding on the Fed, the market will be listening intently to everything their reps have to say. Moving over to gold, we see that it continues to have its moment. Last week, gold closed at $1,902, up 1.19% for the week. And it seems to be starting to getting some notice from the mainstream media, with articles like the one you have in the back of your screen from Bloomberg, or I guess Yahoo Finance republished this article from Bloomberg. But essentially, it starts talking about, is gold set to go even higher? So again, interesting to note. And as we've covered here, just looking back at the chart, all data that we see continues to point towards inflation in the US, and gold prices seem poised to continue riding that narrative higher, both on the macro backdrop and just looking at the technicals on the chart. Again, this breakout of such a long downtrend, as we've discussed here, typically leads to continued run-ups once that range is broken. So again, something to keep our eyes on with the current inflation narrative picking up steam. Moving over to DeFi, we see that both DeFi and Ethereum caught a bid last week. On the DeFi front, that index was up 23.39% for the week at 9,178 points. And we also saw Ethereum higher last week by 13.9%, closing at $2,389. The big news, or an interesting development that came out in this sector, was a alleged leak report by Goldman Sachs. And this is the one you have behind your screen right now, which in this report, Goldman mentions that Ethereum, and I quote, has a high chance of overtaking Bitcoin as a store of value, end quote. And it goes on to refer to Ethereum as the Amazon of information. So a couple of interesting things here is that institutional investors seem to be expanding their curiosity into crypto beyond Bitcoin. And there's also been a lot more talk about DeFi in traditional finance publications. The Odd Lots podcast in Bloomberg in particular has now had 2 consecutive episodes, or almost consecutive episodes, around DeFi, DEXs, and yield farming. So it shows you just how much interest is continuing to brew around the financial community, around DeFi and these types of other protocols. Moving over to our Bitcoin mining difficulty commentary, we see that Saturday brought us a sizable downward difficulty adjustment, dropping almost 16%, difficulty dropping almost 16% to 21 terahashes. And as you see in the back of your screen, the mempool has also stabilized and seems to be quite well on the way down. The weekend actually provided a great opportunity to transact with costs as low as 1 sat per VByte for next block confirmation. Right now, we are at about 61 sats per VByte for next block confirmation. And just a quick update on Taproot. This mining difficulty epoch is well on its way to surpassing the required 90% blocks of signaling for Taproot, which, if done in this difficulty epoch, would be a massive step forward for Bitcoin for this historic upgrade. The signaling ratio, as you can see here, is currently at 97.27%. So if we keep this up, we will be basically moving forward or taking the next step towards this activation. So very, very exciting. And in today's What's Ahead for the Week section, we wanted to spend a minute to talk about inflation in the mainstream media. So inflation is often discussed around financial circles, particularly within the Bitcoin community. However, little is ever said about inflation in mainstream media. When this narrative starts, however, it usually starts with food. I'm going to pull up a few articles here, and give me a second. So, from grocery stores to restaurants, as you can see here in the two headlines that I just showed you, food prices are going up all across the US. From my experience in Venezuela, price increases in staple proteins, particularly chicken and beef, tend to be of particular focus when this narrative starts. Also, look for politicians to start addressing this narrative in the very near future. And US chicken and beef farmers should come into the spotlight any second now. To make matters worse, the US average household net worth may be up in US dollar terms, but the chart we're about to show you shows a different picture or paints a different picture. So the chart that you're seeing and the chart you're seeing behind your screen is the average US household net worth in Fed balance sheet terms. Shout out to Raul Powell for sharing this on Twitter over the weekend. Despite the average savings rate in the US being higher than pre-pandemic levels, despite property prices increasing all across the country, Americans on average are still less wealthy in Fed balance sheet terms today. For the average household net worth to increase, a few things would have to happen. One, the average household savings rate would have to stay high. This requires high salaries. Second, the real estate market should stay healthy and rising. And the stock market also needs to stay healthy and rising. Both of these two latter ones require low interest rates. Those are all addressing the numerator in the equation. To fix the denominator in the equation, the Fed needs to stop printing new cash. At this rate, it looks unlikely that Americans will be able to become wealthier in Fed balance sheet terms anytime soon. To overlay some additional data on this, the Fed is starting to see inflation targets, or is starting to come close to its inflation targets. However, it is still far away from its unemployment target. The natural rate of unemployment in the US is set at 4.4% versus the current unemployment rate of 6.1%. This has many questioning whether the Fed will ever be able to raise rates, as we saw in some of the articles above. So, we've covered a lot today. It's a big week coming up, and as always, we'll keep you posted with any relevant information throughout the week and right here at the Bitcoin Economic Calendar. If you like what you saw today, if you have any feedback or any questions, anything you'd like us to cover in the future episode, please leave it in your comment section below. If you don't yet, if you like that, we also invite you to subscribe to our channel and like the video and share it to your friends. And if you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning 6.1% on your Bitcoin and 11% APY on your USDC. Thank you, everybody. Have a wonderful week and see you next time.